this video, I'm going to talk about one of the most important aspects of expert option trading: timeframes. Timeframes are one of the most crucial parts of trading. Even if you have a strong strategy with a high win rate, using the wrong timeframe can still cause you to lose trades. So in this video, I'll explain what's the differences between candle timeframes and expiration time, how to choose the best time frame for different markets and strategies, the difference between short-term and long-term trades, and finally, how to avoid losing trades due to market noise. One of the biggest mistakes I see beginner traders make is not understanding the difference between candle timeframes and trade duration. Candle timeframe refers to how long each candle takes to form. For example, if you're using 5-second candles, each candle represents 5 seconds of price movement. If you're using 1-minute candles, each candle represents 1 full minute. On the other hand, trade duration or expiration time is how long your trade stays open. For example, if you enter a trade with a 5-minute duration at exactly 6:30 p.m., it will close at exactly 6:35 p.m. It's very important to keep these two settings balanced. If your candle time frame is very small while your trade duration is long, the chart will look fast and noisy. At the same time, if your candle time frame is too large while your trade duration is short, it becomes difficult to properly analyze the market. So choosing the optimal combination of candle time frame and trade duration is key to getting better results. But how do you actually choose the best settings? This depends on two main factors. The first is market conditions. Different markets behave differently. Some markets move smoothly with clear trends, while others are choppy and full of sudden movements. If a market is choppy and unpredictable, it's better to use longer trade durations along with longer time frames. A longer duration helps you avoid being affected by sudden price spikes, while longer time frames reduce noise and give you cleaner price action. The second factor is your strategy. Different strategies perform better on different time frames. For example, the market spike strategy focuses on quick movements, so it requires short trade durations. To spot these quick moves, you also need smaller candle time frames. On the other hand, strategies like market reversal take more time to develop, so they require longer trade durations and larger time frames to work effectively. Another common mistake beginners make is using very small time frames with longer trade durations, thinking it will give them more opportunities. While this may seem like a good idea, in most cases, it leads to losses due to market noise. The simplest way to avoid this is by using slightly longer candle time frames. A good rule you can follow is the 1/5 rule. Your candle time frame should be around 1/5 of your trade duration. For example, if your trade duration is 10 minutes, your candle time frame should be around 1 to 2 minutes. This gives you enough data to properly analyze the trend while also reducing noise. So, make sure to subscribe for more expert option and pocket option videos like this. I'll see you in the next video.